What is going on, traders? Just a quick little video update here. I wanted to give you a quick update on the markets. Tell you what was you know what? I'm going to take this mask off. All of you mask Nazis, be quiet. There's nobody around me. There's literally nobody here. All right. So just a quick little video update on what was the summary from the FOMC meeting minutes. Hopefully you can hear me fine because I'm recording off of the MacBook microphone. But basically, what is causing turmoil in the markets is this right here. So, in terms of the Federal Reserve meeting minutes, there weren't really too many Fed members that agreed with Bullard that a 1% rate by July 1st is necessary. So that didn't cause much of a panic, but the Federal Reserve officials see a faster runoff in the balance sheet. This is what was the main conclusion from the FOMC meeting minutes. And as you know, when you hold $9 trillion in assets, if you're looking to rapidly sell that off, all of those assets are going to hit the market once again, the treasury market, right? Which is not good for the bond market. And Bullard is back to running his mouth again today, saying that there's too much focus on the notion that inflation will dissipate, supporting a 1% rate hike by July 1st. Now, there is truth to what he's saying, even though I personally think, I have a theory. I think that he wants to be the next Fed chair. So he's saying, sort of what is seen as hyperbolic or extreme ideas here, basically countering what Jerome Powell is saying, because if Jerome Powell ends up being wrong and Bullard ends up being right, then we could see Jerome Powell either unseat himself or, when he's done, Bullard could be up next. That is just my personal opinion, but there is truth to what he's saying, because if you look at the inflation in 1980, inflation was 13.5%. And Paul Volcker did not pull any punches. He basically raised the rates and kept the Fed funds rate at 20% during that year. And inflation dropped from 13.5% in 1980 to 10.3% in 81. Again, federal funds rate as of February 3rd, 1981 was 20%. And look at this. The very next year, with a high Fed funds rate, inflation dropped to 6.2%. The year after that, inflation dropped to 3.2%. So a faster ripoff off of the Band-Aid, basically what Bullard is saying, is there is truth to that historically, and we're nowhere near these inflation numbers, but we're not that far off based on the trajectory that inflation and supply chain issues are at right now. Now, in my view, we're still in this W formation in the S&P 500, and there is still a buying opportunity here, only selectively on high quality stocks that have already proven their worth through their earnings. Remember, the stock market is forward looking. The stock market wants to reward companies that have shown they can grow, and the way that they do that is through their earnings reports and the guidance that they provide. I would not trade high beta stocks here. Like, I know that there are some stocks that seem lucrative and maybe attractive at this point. Think of PayPal or SoFi or DraftKings or whatever. But, although those can see short-term runs and there are days when they will rally double-digit percentage points, I would focus on sticking to high quality stocks here and use this sideways market or this drawdown as a time to educate yourself about the market, learn how to read a balance sheet, learn how to read a chart, learn how to evaluate a company, right? A lot of times you'll hear people say, oh, this stock is too cheap right now, or this is a great price. But, they're saying that arbitrarily without really any backing, without any valuation metrics. How many times sales is it trading? How many times earnings is it trading? Anyway, guys, quick little video on the Fed meeting minutes and what I think is necessary in order to curb inflation. I do agree with Bullard that we do need to rip the Band-Aid off a little more severely than this slow, gradual increase. However, we will know when the next CPI print comes out next month. And for sure, the Fed is going to raise rates on March 16th. It's just a matter of by how much. And we'll close with looking at what the Fed Watch tool is predicting at the moment. You'll see that the Fed Watch tool is predicting it's back down now to after the Fed meeting minutes were released. Most Fed members think that we will only be raising rates by 25 to 50 basis points on March 16th, with only 32% of the members thinking that we will get to the 50 to 75 basis points. So this isn't really what's causing turmoil in the market. It's a little bit of the pre-war, if there is going to be a war, pre-war bantering between NATO, Russia, Ukraine, and the United States, as well as This right here, the Fed officials seeing faster runoff and balance sheet, which was a result of the meeting minutes. So hopefully that makes sense. If you want access to all of our plays, link is in the description below. We continue to maintain our hedges. We closed our SPY hedge this morning for 83%. Had a nice iron condor on Tesla as well. Made about 50% on that. But we're being very selective with our plays here. So if you want access to all that, link is in the description below. Leave a thumbs up. Let me know what you think of this video. Let me know what you think of the markets. Are you buying? Are you holding? What are you doing? Stay safe out there, traders. Peace.